The world surrounding the Iraqi dinar is often clouded with speculation, rumors, and conflicting information, making it difficult to discern fact from fiction, especially when a potential revaluation is discussed. Today, we're cutting through the noise to tackle a subject that is not just about currency, but about honoring the trust and foresight of family members who may have passed on this investment. The profound nature of this issue was brought to our attention by a dedicated member of our audience, whose personal situation involved an inheritance of dinar. Their query, straightforward yet deeply resonant, was whether proof of purchase, specifically receipts, are an absolute necessity for successfully exchanging the Iraqi currency. This isn't merely a practical banking question. It carries the emotional weight of a legacy, and we recognize that countless others harbor the same anxiety. Wondering if their preparations are sufficient, the simple and reassuring truth, which we want to establish clearly from the outset, is that receipts are not a mandatory requirement for completing a currency exchange. This revelation often comes as a surprise, perhaps even a shock, to those who have spent years internalizing the pervasive rumor that a lack of paper trail would render their dinar worthless or untradeable. This belief has unfortunately been fueled by a continuous stream of misinformation circulating within the broader dinar investor community. Many people needlessly worry that approaching a bank or financial institution without a receipt, a clear proof of purchase, will lead to their currency being rejected outright. The fear is that the bank will demand an exhaustive purchase history detailing exactly where, when, and from whom the dinar was acquired. This concern, however understandable given the longevity of the dinar discourse, misrepresents the operational priorities of major financial institutions. In reality, banks are not primarily concerned with tracking your individual spending patterns or investigating your history with foreign currency purchases. Their core business is not to audit your personal buying habits. Therefore, they do not require you to present a dated invoice from an overseas currency dealer or a receipt from a broker to validate that your banknotes were legally purchased. That type of documentation is personal, not procedural. The fundamental focus for any bank or redemption center is the physical currency itself, the banknotes you present at the counter. The institution's main concern is whether the Iraqi dinar you possess is genuine, valid, and in a condition suitable for conducting a formal transaction. If the currency meets these physical and legal standards, that is what truly matters. Irrespective of how or when you obtained it, a receipt merely serves as evidence of where you acquired the currency, but it does nothing to alter the fundamental nature of the money in your hand. While keeping receipts is certainly a commendable practice, particularly for meticulous personal record-keeping or eventual tax purposes, it does not function as a prerequisite for the actual exchange process itself. The currency's legitimacy is wholly independent of the accompanying paperwork. As an individual widely respected within the dinar community, Frank 26 has encapsulated this principle with striking clarity and simplicity. His summary echoes the essential reality. Having receipts is undoubtedly helpful, as it streamlines personal organization, but their absence does not present a roadblock to the exchange. The bank's imperative is the verification and acceptance of the currency, not an inspection of your entire financial history leading up to the transaction. This concept becomes even clearer when you consider the standard practices for foreign currency exchanges involving ordinary travelers. Imagine a person returning home after a vacation in Europe, holding a modest amount of leftover euros, who then decides to convert them back to their native currency at a local branch. It is a near certainty that this person will not be asked to produce a receipt from a souvenir shop or an ATM withdrawal slip as proof of how they acquired those euros. The exact same principle applies to the Iraqi dinar. Despite the sensationalism that often surrounds it, while some investors carefully purchase from officially licensed currency dealers and maintain impeccable records, others may have bought their notes many years ago through varied and informal channels. The crucial point remains: once you are in possession of authentic currency, the exchange depends on its intrinsic legitimacy as a medium of value, not on an exhaustive paper trail. Therefore, receipts may offer a degree of personal reassurance or be invaluable for providing structured documentation to a professional accountant, but they absolutely do not hold the keys to the exchange vault. The paramount concern for any institution handling foreign exchange is authenticity and legality. Their primary responsibility is the meticulous assurance that the Banknotes being processed are genuine and not counterfeit, a standard protective measure for both the bank and the client. This is precisely where the bank's attention is focused, rather than on cross-referencing whether you purchased your dinar in 2005, 2012, or just last week. The institution's sophisticated security protocols replace the need for anecdotal evidence. Financial centers utilize advanced tools and methods to quickly verify authenticity, including but not limited to UV scanners, watermark checks, and security thread validations. These are universal industry-wide procedures. Once the authenticity of the currency is confirmed through these standardized security checks, the exchange becomes a purely transactional matter. The bank simply applies the prevailing official exchange rate, calculates the final amount, processes the transfer, and disperses the resulting funds to you. This is the standard operating procedure applied uniformly to every foreign currency transaction, be it the euro, the yen, or the Iraqi dinar. The definitive message is exceptionally clear. Receipts are not a requirement for the exchange of Iraqi dinar. While possessing them offers a tangible benefit for personal record keeping, especially concerning future tax filings, they are not an essential component of the actual exchange process itself. The fate of your transaction rests entirely on the currency in your hand. If your notes are verified as authentic, in good condition, and pass the bank's security inspection, they are exchangeable. Any anxieties stemming from the fear that your currency will be rejected due to a missing receipt are completely unfounded. Banks operate according to rigid policies, procedures, and regulations that prioritize the legitimacy of the money itself over the convoluted narrative of its acquisition. As long as your dinar successfully passes the bank's tests for authenticity, you hold everything required to move forward. Everything else, including receipts, invoices, or personal logs, is purely optional. When the significant moment arrives to exchange your currency, approach the bank with confidence. The power to complete the transaction is vested in the authentic banknotes you possess, not in the decades-old slips of paper you may or may not have managed to retain. It's imperative to consistently separate the reality of banking procedure from the pervasive rumors that have characterized the dinar community for so long over the years. Investors have been subjected to various contradictory narratives. Some insist on rejection without receipts, while others claim banks demand proof for every single purchase ever made. The reality, fortunately, is far more straightforward, relying on the same procedures banks apply to all foreign currency exchanges globally. The financial system is governed by clear guidelines that prioritize the customer's identity, the currency's legitimacy, and adherence to established compliance regulations. To put it plainly, when you enter a bank or an authorized redemption center, there will be no lengthy, stressful interrogation about the precise source of your dinar, the name of the vendor who sold it, or whether your paperwork from a decade ago is pristine. Instead, the process involves a concise and methodical checklist that all institutions are mandated to follow. The central issues are whether you are a legitimate customer, whether the money is genuine, and whether the transaction adheres to anti-money laundering (AML) laws. For those who have agonized for years over the possible consequences of lost receipts, particularly for purchases made 10 or 15 years in the past, a great sense of relief is warranted. Your ability to exchange your currency is not conditional upon outdated, potentially misplaced paperwork. It depends solely on the authentic, physical Iraqi dinar notes currently in your possession. These bills are what hold the recognized value and grant you the right to proceed with the exchange. However, there is one simple and critical answer that explains the persistent, almost obsessive emphasis placed on receipts within the investment community: taxes. While a receipt is not required to complete a currency exchange at a financial center, it becomes extremely important when it is time to report your financial activities to relevant tax authorities, such as the Internal Revenue Service, IRS, in the United States. This is a common point of confusion for many investors. The primary function of receipts, in this context, is to meticulously document your original investment price. This documentation is crucial for accurately calculating your subsequent capital gains or taxable income. Following a revaluation, when the dinar is exchanged for a significantly higher value, the difference between what you initially paid and the final exchange value is classified by the government as a gain subject to taxation. Without this necessary documentation, you risk a considerable tax overpayment. The tax authority might, in the absence of evidence, assume you had no initial investment whatsoever. Therefore, receipts provide irrefutable proof of your cost basis. which is the total amount you originally spent to acquire the currency. This cost basis is the single most critical figure, as it determines how much of your profit is actually subjected to tax stop by holding onto your receipts. You can explicitly demonstrate your initial expenditure to acquire the dinar, ensuring that you are only taxed on the actual net gain, rather than on the entire amount received from the exchange. Conversely, without receipts, the government could legally treat your cost basis as effectively zero, which has the potential to cost the investor tens or even hundreds of thousands of dollars in wholly unnecessary taxes. This disparity clearly illustrates why financial experts constantly stress the vital importance of maintaining diligent records of all dinar purchases. The essential takeaway is that receipts do not determine the bank's willingness to process your currency, but they are an indispensable tool for protecting your profits and financial health once the transaction is complete. Proper documentation is your safeguard against inaccurate tax calculations and unnecessary financial loss. The situation becomes slightly more nuanced, yet often simpler when the Iraqi dinar is managed as part of an inheritance. If the deceased investor was careful enough to leave behind both the physical currency and the accompanying documentation such as receipts, purchase records, or account statements, the inheritor is in an excellent position. This paperwork establishes clear evidence of legal ownership, which greatly reduces potential friction or confusion when presenting the currency for exchange. When handling inherited currency, banks require verification that the individual presenting the notes is the rightful legal owner, and an inherited stack of dinar accompanied by proper estate documentation, like a will or trust documents, satisfies this requirement efficiently. Additionally, inherited currency often confers significant financial and tax advantages to the heir, which can be an enormous benefit to their financial future. One major advantage is the potential for a stepped-up cost basis. This means the tax authority may calculate capital gains based on the dinar's market value at the time the original owner passed away, rather than the lower price the original owner initially paid. This single factor can dramatically minimize the taxable gain upon eventual exchange, providing a substantial financial advantage for the inheritor and honoring the original investor's foresight. Beyond the technicalities, an inheritance with a clean paper trail provides invaluable peace of mind. It signifies that the relative not only made a wise investment but also proactively created a clear record that protects their heirs from unnecessary tax burdens or legal disputes. Consequently, the process of exchanging inherited dinar, when accompanied by documented ownership and the necessary estate records, is generally straightforward and less stressful for all parties involved. The realization of losing receipts can understandably trigger immediate panic, especially when anticipating future tax obligations on a large investment. Many individuals jump to the conclusion that they are now doomed to pay maximum taxes or face auditing difficulty without the physical proof of purchase. However, it is vital to remember that a lost receipt is not an automatic financial death sentence or an insurmountable legal hurdle. There are, in fact, multiple effective methods available to legally and accurately reconstruct your cost basis and spending history, even in the complete absence of the original documentation. The path forward requires patience, careful organization, and a systematic utilization of alternative records that can be presented as verifiable evidence of the original transaction. You are not at a dead end simply because a slip of paper is missing. In a great many cases, tax authorities and financial regulators are willing to accept reconstructed records as long as the supporting evidence is thorough, logically sound, and can be verified through other means. By being proactive, understanding the available options, and methodically rebuilding your documentation, you can often satisfy both legal and tax requirements. This proactive approach significantly reduces stress and prevents the needless overpayment of taxes, even without the original receipts. It is entirely feasible to build a defensible cost basis for investments like the Iraqi dinar by using available alternative records. One of the most reliable sources of such information is your old bank transfer records. Bank statements typically contain detailed information, including the precise transaction dates, the exact amounts, and the names of the recipients, all of which serve as compelling proof of the original purchase. Similarly, credit card statements offer comparable evidence of payments made to specific currency dealers or vendors. These records are especially valuable because they establish the exact amounts and dates which are critical components for accurately calculating the cost basis required for tax reporting purposes. These documents act as an official record of money movement that an auditor can easily verify and trust. Another resource that is often overlooked, but can be highly valuable, is your email confirmations from dealers. Many reputable online currency and specialty dealers send out detailed purchase confirmations that outline the quantity purchased, the final price paid, and the specific transaction date. Even if the physical receipt is lost, these digital records can provide extremely strong and persuasive evidence of your original purchase details. Establishing a powerful paper trail. By gathering information from multiple independent sources, you are constructing a comprehensive paper trail that visibly demonstrates your reasonable and honest effort to reconstruct lost records. This systematic approach is generally recognized and accepted as a legitimate way to prove financial transactions, provided that you clearly document your research process and supply as much detail as you can reasonably locate. If your personal records, such as bank statements or email confirmations, prove to be incomplete or inconclusive, another highly effective strategy is to directly contact the dealer from whom you made the original purchase. Many reputable businesses, especially specialized dealers in items like collectibles or foreign currency, maintain detailed, long-term transaction histories for their clientele, sometimes going back many years. By providing the dealer with identifying information, such as your full name, the approximate date of the transaction, or an account number, they can often locate and provide duplicate copies of invoices or detailed statements that thoroughly verify your original purchase. It is crucial to manage this method systematically, meticulously log all communications, and request documentation in a clear format that explicitly identifies your purchase, the amount paid, and all other pertinent details. While this process of contacting dealers may require patience and time, it is an extremely successful way to replace lost receipts and significantly strengthen your overall documentation for tax purposes. Most reputable dealers understand that customers frequently require these records for tax compliance and are typically willing to cooperate fully. By being thorough and persistent, you can effectively mitigate the consequences of any lost paperwork, even in scenarios where you are unable to locate perfect, exact documentation. The situation is far from hopeless. Reasonable estimates are often permitted and accepted by tax authorities, provided they are supported by thoroughly documented research. For example, if you can establish the approximate date of the purchase and confirm the price range from several credible external sources, you can create a reconstructed record that explicitly outlines your estimation methodology. It is absolutely crucial to maintain complete transparency about the steps you took to arrive at your estimates, including which sources you consulted and the logical process you followed. Providing detailed notes and explanations demonstrates to tax authorities or auditors that you acted with a conscientious effort to accurately account for your expenditures. A well-documented estimate is virtually always considered superior to simply giving up or claiming zero deductions. This proactive and diligent approach not only works to mitigate the risk of paying excessive, unnecessary taxes, but also clearly demonstrates that you are an organized, responsible, and proactive financial manager. By combining all available resources, including bank statements, credit card records, email confirmations, dealer records, and documented reasonable estimates, you can construct a credible and legally defensible record of your transactions, ensuring you minimize financial risk even when the original receipts have been lost. To summarize the central theme regarding the Iraqi dinar, it is easy to become fixated on the idea that receipts are an absolute mandate for every financial step. The definitive truth is much simpler. You do not need receipts to exchange your dinar. The physical currency is the primary asset. Nevertheless, receipts maintain a crucial, supporting role not as a requirement for the exchange itself, but as an essential financial and legal safeguard to document your initial investment for subsequent tax reporting and audit protection. If you personally purchased your dinar and have maintained the receipts, you are in an ideal position. Similarly, if you were fortunate enough to inherit dinar alongside its complete paperwork, you are already strongly positioned. Your family members' thoughtful planning has significantly simplified your record keeping and established a robust foundation for future financial clarity. For those who lack the original receipts, remember that this is not a dead end. By systematically and calmly reconstructing your purchase history using readily available alternative methods, such as banking records, credit card data, emails, or dealer communications, you can successfully create a credible and legally defensible record of your investment. The key is to remain composed, approach the documentation process with method and diligence, and record every step you take. Panic is counterproductive, while organization is your most powerful tool. Ultimately, possessing receipts is fundamentally a matter of preparedness and protection, not a matter of permission to access your own funds. Here is the simplest breakdown of the common questions. Do you need receipts to exchange? No, the authentic currency is enough. Do receipts help you legally after the exchange? Absolutely, they are essential for tax documentation. What if you inherited the dinar with paperwork? You're in a very strong position. And what if you don't have receipts? Don't panic, reconstruct the records using alternative, verifiable documentation. By answering these fundamental questions directly and honestly, it becomes apparent that the ultimate focus should be on thorough preparation, not demanding unattainable perfection in paperwork. A missing receipt is an inconvenience, but it is certainly not a catastrophic event that invalidates your investment. To ensure you are fully prepared for the eventual exchange or management of your dinar, we recommend a simple checklist for all holders. First, organize your dinar notes. Treat the physical currency as your most important asset, keeping it sorted, stored securely, and meticulously accounted for. Second, prepare your identification, such as a passport or a driver's license. Banks require proper, valid government-issued ID for all significant transactions, so ensure these documents are up to date and immediately accessible. Third, collect or reconstruct your purchase history. Whether through original receipts or diligently reconstructed records, these documents are what will protect you from potential tax complications or audits, and provide you with lasting peace of mind. Fourth, and finally, ensure you keep both digital and physical copies of your records. Redundancy is a critical financial safeguard. Having both versions ensures that if one set of records is ever lost or destroyed, you still retain comprehensive proof of your original purchases. Following this simple, four-step checklist does much more than just facilitate a smooth future exchange. It ensures that you are organized, protected, and fully confident in your financial position. Our final message to you, the viewer, is this: if you are currently holding Iraqi dinar, whether you acquired it personally or through an inheritance, you already possess the asset. That simple fact grants you the power and leverage to manage it responsibly. Receipts are important, yes, but they are designed to be a financial shield for future security, not the mandatory ticket to ownership or exchange. Their primary and vital purpose is to protect you from future inquiries, tax complications, or financial audits. The ultimate takeaway is simple: stay calm, stay organized, and trust that your diligent preparation will carry you through. By following this checklist, documenting what you can, and knowing the alternatives available for lost paperwork, you position yourself to manage the currency responsibly. When the appropriate time comes to exchange or manage your dinar, you will be truly ready, highly confident, and exceptionally well prepared. There will be no need for panic or stress. This methodical approach is the best way to secure your peace of mind today, while proactively guaranteeing your financial clarity and security for all the tomorrows to come.